AS 22, accounting for taxes on income. Another very practical standard, uh, very interesting standard actually for me. AS 22, the crux of AS 22 is about taxes. Okay, and here we are not focusing more on current tax. The focus is going to be a little more on deferred tax. Okay, first let us understand what is current tax and what is deferred tax. Current tax is nothing but the tax liability that you incur or that you are going to uh, pay every year. So basically what you call as provision for taxation. Okay, so it refers to the tax liability arrived by the entity for each year based on which the provision is created. So tax expense account debit to provision for taxation, or current tax account debit to provision for taxation. That is what is shown in the profit and loss account as current tax. So this is arrived based on the uh, income tax provisions. Okay, or based on the prevailing provisions, we calculate the current tax payable. Now deferred tax is something where it is not calculated based on uh, income tax alone or based on books alone. It is an attempt to bridge books of accounts and income tax. So when it comes to tax, we all know that there are certain items where profit or loss calculation as per books of accounts is different and profit or loss calculation as per income tax is different. Simple examples like depreciation has different rates. Then if an expense, cash expense is paid more than beyond 30,000 rupees, 10,000 rupees, sorry, pare provision 10,000 rupees, then it is disallowed in income tax law, whereas in books we don't have such rules. Correct? In income tax law, some assets like some manufacturing assets can have 100% depreciation. Some assets we can have additional depreciation. Whereas in books, can you give accelerated depreciation? No, we can only give the normal depreciation. Then you can adjust the brought forward previous year losses while calculating profit, income tax profit. But can you adjust previous year losses for books? No. So all these are certain examples where the calculation as per books of accounts and calculation as per income tax drastically vary. Now, books, we calculate the profit as per books of accounts. So tax also, if it is as per books of accounts only, matching concept is followed. Else matching concept is not followed. So to ensure that this match is achieved, we are going to find out what are all the differentiating factors. What are all the factors that cause the difference between income tax law and the books of accounts? And for that, what we will do, we will calculate the tax impact. And that tax impact will be accounted as deferred tax. This is what is the concept behind deferred tax in a nutshell. Okay. So now, when we go to this books of accounts, the standard says the differences between the books and income tax law can be of two types. The differences are permanent differences and temporary or timing differences. So what is permanent difference? Thus, there are certain differences which can never get compensated over a period of time. For example, the most direct example is this cash expenses beyond the 10,000 rupees. Once disallowed, always disallowed. It is not like next year I will allow it. No. So this year, if you are paying more than 10,000 rupees in cash, disallowed, flat. Whereas in the books, we are going to take it as an expense. Donation. For calculating book profit, donation will be taken as an expense in accounts. Whereas in your income tax law, donation is not allowed as an expense unless it is recognized under ATG. So ignore ATG for a minute, but for calculating profit and loss, will you consider donation? No, permanently disallowed. Right? Similarly, there are certain other expenses where the disallowance is of a permanent nature. So they are called as permanent differences. Now coming to the next part, which is timing differences. What is this timing difference or temporary difference? There are differences between accounts and book and income tax provisions, but the differences get offset over a period of time, like depreciation. Eventually, the value of the asset is say 1 lakh, 1 lakh. Depreciation will be for this 1 lakh only. Probably in the earlier years, more depreciation under income tax, then under books, lesser depreciation, and vice versa. So, in the year on year, the value might seem different, but overall, if you look at the impact, it will get knocked off or adjusted. Another example, if tax is not deducted at source, what is the disallowance? 30% disallowance in the given year. So this year I have not deducted tax at source. Will you subtract that amount in the books? No. I will still be showing the full amount as expenses in the books. However, if in the income tax law, he says that if tax is not deducted at source, I will allow only 70% of the expenses, 30% will be disallowed. So what happens here? There is a gap. Now that 30% next year, if you are paying the tax on time, or next year or within the due date of filing returns, if you are going to pay the TDS, then that amount is getting allowed. That 30% can be claimed in the next financial year. So what happens? That 30% amount alone gets transferred to the next year. So within 2 years, the amount gets offset. So where there is a difference, but the difference can get offset over multiple years, 2, 3 or more than some years, then they are called as timing differences. So these are the two types of differences recognized under the standard. Okay. The standard rule is very simple. Permanent differences, we can't do anything about it. So no impact has to be given for permanent differences. So for permanent differences are those items that will never get set off over the years. Your examples can be cash expense, donations, etc. No deferred tax is created for permanent differences. Okay. Timing differences. The difference between books and income tax is offset over the years. Now for this timing difference only, we are going to do this matching concept by creating deferred tax impact. Now how to calculate the deferred tax impact? Let us remember the rule. We will compare the income tax profit and the book profit. We are not comparing the expense or income. We should see, say for example, if you are going to have depreciation, because of depreciation, whether income tax profit is high or book profit is high, we should not compare the depreciation value, but we should compare the profit value. So suppose income tax depreciation is 20,000, books depreciation is 10,000. So in income tax, depreciation is high. Therefore, profit as per income tax will be low. So remember this rule. Do it accordingly. Never compare the expense or the income. Go by the profits logic. Okay. So now we are going to compare income tax profit and book profit. Now when we compare the two, we are going to see if income tax profit is greater than the book profit. Okay. So if income tax profit is more, then it will result in a deferred tax asset. How to logically remember? Okay. Income tax profit is more. So today I will pay more tax. Today if I am paying more tax, tomorrow it is a benefit for me. Deferred benefit, therefore asset. Okay. So income tax profit is more than book profit, then deferred tax asset is created. For what value? The asset is created not for the profit difference. The asset is created for the difference amount into applicable tax rate, because that is the benefit that you are getting actually. So for the difference value into the tax rate. Similarly, if income tax profit is less than the book profit, now I am paying lesser tax. So in the future, I have to pay more tax. So it becomes a liability, deferred tax liability. So the difference into tax rate will be treated as deferred tax liability. Okay. So remember this rule, compare only the book profit and income tax profit, or accounting profit and income tax profit. Now, the rule is deferred tax asset will be separately calculated for whatever items are applicable. Deferred tax liability will be calculated, but they cannot be shown separately in the books. AS 22 says whatever items you have for DTA and DTL, combine. whatever is the net impact of DTA or DTL, the net value alone shall be recognized in the books. Say if you have 5 items of DTA, 2 items of DTL, combine the values, see what is the net impact, and that will be recognized in the books. And for that also, the rule is DTL shall be recognized, which means deferred tax liability shall be provided for prudence. A liability is recognized, whereas a deferred tax asset will be recorded only if the company has a reliable estimate of future profits, which means if you know that the company will make profits in the future. Okay, unless you are having evidence of profit making, you should not recognize DTA. Right? So, for this evidence, it is the management's discretion and the auditor's call. They have to decide whether the company has reliable estimate of future profits. So, remember, DTL or DTA should be net off for all the items and recognized in the books. Clear with the rule, friends? Okay. Your primary questioning area will be, they will be giving you items, certain line of items, and you have to calculate whether DTA or DTL arises on such items. Okay. Now, when it comes to a tax holiday period, what is a tax holiday period? A period for which there is no tax payable by the company. Say, if the company is a startup, probably there can be a period for which a tax benefit is granted, where for the first 5 years tax need not be paid. Tax will be paid only from the 6th year, even if the company is making profit for 5 years. So, for the tax holiday period, if there is a DTA or DTL, then the rule is, if the DTA or DTL is getting offset within the 5 years, okay, then to the extent it is getting offset, it shall not be recorded. Say for example, okay, let's take an example and understand. Year 1, let's say the DTL, net DTL comes to 25,000. Okay. Year 2, there is a net DTL of again 10,000. Year 3, there is a DTA of 45,000. Okay. Or, okay, 45,000. Year 4, there is again a DTA of 10,000. Now assume that the tax holiday period is for 3 years. Okay, assume that the tax holiday period is for 3 years. So, year 1 DTL. Now here, normally we will record this DTL in the books. But if it is a tax holiday period, see what is the total DTA or DTL for the tax holiday period. Total is 25,000 plus 10,000 minus 45,000. So this DTL is getting offset by this DTA. Correct? DTL created is getting offset by this DTA. Therefore, it shall not be recorded because the offset is happening within the tax holiday period. Okay? Same way, please wait, allow me to complete. DTL for second year is 10,000. Again, is it getting offset by DTA in the third year itself? Yes. So, again, it will not be recorded. Now, in the third year, which is still in the tax holiday period, 25,000 DTL offset, 10,000 offset. So, what is left out? 25 plus 10, 35,000 gone. I am left with another 10,000 rupees. That 10,000 alone shall be recorded as DTA in year 3. Okay. So, here, year 3, year 3, 10,000 alone shall be recorded as DTA, provided we have the estimate of future profits. That is always there. Okay. So, year 1 and 2 will I record? No. Why we will not record? Because it is getting offset within the tax holiday period. We have to calculate it. When so in the year one, for whatever available items is there, say for example that year expense you may not know, but for items like depreciation or certain long term benefits, you will know what is the DTA or DTL. To the extent that is available, you should calculate the offset. Every year it will change, book profits will change, but you will know the DTA or DTL for certain items from the beginning itself. Say for example, today I am purchasing an asset. You know, for this asset, book depreciation is this rate, income tax depreciation is this rate. So now you can immediately calculate for that asset till the end of its useful life. You can calculate DTA and DTL. Like that, for every item we can compute. And to the extent it is getting offset, we should not record. Is it clear? Most practical cases in this situations will be for depreciation. 99% practical applicability of this situation is under depreciation. Then nothing is getting offset. Then year 1, year 2, year 3 I have to record. So I am coming to that example. Okay, suppose this is scenario 1. Now scenario 2, I am changing the example by a little numbers. Okay, scenario 2, same tax holiday is 3 years, DTL 25,000, DTL 10,000. Here DTA is, let us assume 8,000. DTA is only 8,000. Now year 1, 25,000 DTL, which is getting offset by a DTA amounting to 8,000 only, which means I still have excess DTL amounting to 25 minus 8, 17,000. So here in year 1 itself, I will record 17,000 DTL. Okay. In the first example, the entire amount got offset, so we did not record. But in the second example, only partial offset is happening, so I need to record in the same year itself. Year 2, what will happen? No offset is available, because whatever was available we exhausted in year 1 itself. So year 2, what we will do, full 10,000 will be recorded as DTL. Within the tax holiday period. After tax holiday period, normal calculation. As it is that year, that amount will get recorded. Within the tax holiday period only, you need to be careful about offset. Yes, ma'am? Okay. Situation 3. Year 1 DTL 25, year 2 DTL 10,000, year 3 also DTL 5,000. So here what happens? In year 1, year 2, year 3, that is within the tax holiday period, there is no offset. So you should record the entire amount as it is. So year 1, I will record 25,000 DTL. Year 2, I will record 10,000 DTL. And year 3 also, we will record 5,000 DTL. That year, that tax. When it is offset, the excess amount alone will be recorded. If it is fully offset, nothing is recorded. Okay. So 3 scenarios for your understanding. So your possible question from this chapter are basically two types. Predominantly asked so far has been two types. One, they will give you certain scenarios where you will have to calculate MAT. Sorry, you have to calculate the DTA or DTL. And second is where there is a tax holiday period, you need to calculate whether there is an offset or not. Someone online asked me a question. Can you repeat the question, please? I think I missed it. No, in the first year, okay, you are asking in the first year whether I will know that in year 3 I will get a DTA. Yes, you will be able to calculate, especially for items which are long term in nature. For revenue items, you may not be able to calculate. This adjustment is mainly relevant for long term items like fixed assets, etc., for which you can calculate whether DTA or DTL will arise. And remember, DTA and DTL here is not consolidated. You can also do it on an individual basis. Item to item basis, you can calculate. So, in that case, you will still be able to arrive at the net DTA or DTL set off. Okay. So, this is the second area of discussion. The third point, so far, yes, ma'am. Mm. That amount, what you need to do is in the year in which the change has happened, you have to record it. That's okay. Prospective impact. If the change has happened, so if you say what if the tax rate change in between, in that case, the year in which the change happens, change the provision, and whatever is the difference because of the that in DTA or DTL, record it. Yes. Okay. So coming to the last part of this standard, in case of minimum alternate tax, MAT. What is minimum alternate tax? It is a tax that is to be paid by the companies as a minimum percentage of a profit that is calculated under not under normal provisions but under a different set of provisions, right? So we calculate separate provision book profit for the purpose of MAT. Now, if suppose the company is paying tax not under the normal provision, but it is paying tax under MAT, then company has two benefits. One, difference between accounting profits and income tax. And second is difference between income tax and MAT. Normal income tax provisions and MAT. So here, deferred tax will be difference between book profit and income tax profit. So when I say income tax profit, I mean the normal provisions, which will be given as per IT provisions or as per regular provisions. And the second one will be the difference between actual MAT calculate a profit as per calculation for MAT and income tax. Okay, so this will be your calculation for MAT. So far not tested, but if tested, it can be a small 5-mark question. So far they have not tested much around MAT. Okay, the last few years testing is around the first two topics only. Okay. So for this standard, what is more important is you should be clear, at least have a basic remembrance and memory of the provisions of income tax law. Because certain provisions, they will not give you in the exam that this is allowed, this is disallowed. You have to remember that this is allowed and disallowed. Like for example, donation. We have to remember that as per income tax, it is disallowed for profits calculation. Cash expenses paid. About 10,000 na disallowed. So TD expenses for which tax is not deducted. So certain basic provisions. Let's not go into the depth of income tax, but basic provisions you need to remember while doing this AS22. Okay. So clear with the provisions, friends? Run through and you can ask if there are any doubts. And then we will start with the practical questions. Okay. Okay, I'll repeat the MAT provision. MAT provision is for calculation of tax as per minimum alternate tax provisions. So where as per income tax provision, if you are getting a lesser profit, And as per minimum alternate tax, if you are getting a higher profit, so we have to pay tax based on that minimum alternate tax provision. So in that case, for deferred tax, there are two benefits available. Normal book profit and income tax only we will consider. So that is the normal deferred tax. Additionally, we also have a gap between income tax profit and MAT. That gap also will get accounted for deferred tax. That gap also we need to consider for the tax calculation, deferred tax calculation in the books. Okay. 115, section 115 JB, JA, JB, JB, correct. For you, it is AMT is there in your syllabus. 115 JA, AMT in படிப்பீங்கல்ல. Alternate minimum tax படிச்சிருப்பீங்க. For companies, it is called as minimum alternate tax. That is a different provision. You will learn it at primary. So AMT or MAT, whatever they give, the concept in terms of AS 22, it is the same. Okay, AMT and MAT in principle are the same things. Where AMT is applicable for other entities, MAT is primarily applicable for companies. That is the only differentiating factor. Okay, so question la AMT கொடுத்துட்டாங்க அப்படின்னா don't panic, it is the same thing, same MAT rule you can apply and you can answer. Right? So can we start with the practical questions? Question number 4. The following transactions were reported by PQR Limited during the year 2020-21. The tax rate is given as 30%. Items disallowed in 1920 and allowed in 2021. So it was disallowed in the previous year, but current year it is allowed. Next, interest to financial institutions accounted in the books on accrual basis, but actual payment was made before the due date of filing and allowed for tax purposes. In the allowed for tax purposes illanalu, we should remember this provision. It is a statutory payment, 43B, section 43B of Income Tax Act. Okay, so that section says if you are going to make the payment before the due date, then it is allowed as per income, like bonus, employee payment. So all this come under statutory payments. I hope you remember. Okay, so in that case, you have to calculate, you have to understand whether it is allowed or disallowed. So what is the rule? If the payment is made before the due date of filing returns, it will be allowed. Next, donation to private trust made, not allowed under income tax. So no benefit is available basically. So now we are going to calculate the deferred tax calculation for these three items. Go ahead. First, estimate the deferred tax impact, and then let us understand whether it is deferred tax asset or liability. Shall we? Shall we do it parallelly? Okay. Items disallowed in 1920 and allowed for income tax purposes. So now we are in the books of 2021. Now in 2021, in income tax, it is taken as an allowance. So income tax expenses more. Income tax expense is more. In books, have we considered this expense? No, it was considered in the previous year, not in the current year. So in book, expenses is less. So now think about profits. Income tax profit will be less, book profit will be more. I repeat, the rule is in income tax, we are having more expenses. So income tax profit will be less. In the books, the expenses are less because these expenses pertain to the previous year. So book profit will be more. So when income tax profit is less, we will pay lesser tax. So paying a lesser tax will incur a liability for the later, which means it is a deferred tax liability ideally. But friends, since it is a disallowance in the previous year, this amount would have been called as a deferred tax asset. Previous year in 1920, book profit would have been less, income tax profit would have been more, we would have got a deferred tax asset. So when it is a reversal of the previous year, remember this point, when it is a reversal of the previous year, you should use the word reversal. We should use the word reversal when we write the answer. So now, in this case, we found out the answer that it is a DTL, deferred tax liability. But actually, it is not a liability created in the current year. It is a reversal of the asset created in the previous year. So your answer key will also have this word reversal of deferred tax asset. It will not have deferred tax liability. Okay. So you should write reversal of deferred tax asset. So how to check, how to remember this? If the question is about any previous year disallowance or allowance, அப்போ previous yearல அது என்னன்னு பாருங்க. What happened to it in the previous year? Opposite of it only will happen in the current year. So naturally you can write reversal. Okay. So this is a reversal of a deferred tax asset. I hope I'm clear. I will come to it. Second, interest to financial institutions accounted on accrual basis, whereas payment was made before the due date. So, accounted on accrual basis, payment made before the due date. So, is it allowed as per income tax? Allowed. Allowed as per books? Allowed. Because it before due date, so income tax also no problem. So, is there a difference between books and income tax? No. So, we will write no difference. Accrual basis, interest expense is allowed in books. No difference. Third, donation made to a private trust in 2021. So this is a current year payment. Current year, in the books, it is an expense. In income tax, is it allowed? No. So now tell me, book profit versus income tax profit. In books, I have put this expense. Therefore, book profit will be less. Income tax profit will be more. So I am going to pay more tax now, resulting in a benefit for the later. Therefore, it is a deferred tax asset. It is a deferred tax asset. Friends, I would encourage you to remember the logical flow instead of remembering it greater, it less in a DTA, DTL. That probably might confuse you in the exam. So remember the logical flow of it. It is easier for you to present your answers. So now let us see how to present the answers. In income tax, we will disallow it, so it will not be shown as an expense. Add back the profit. Profit increase. Income tax profit is added. Book profit, pay more tax today. If you're paying more tax today, therefore, future you are going to pay have a benefit, right? I'm showing the wrong question. Yeah. Okay. First question. Disallowances as per IT Act. Tax payable was higher for the earlier year. Therefore, it is a reversal of DTA. What is the amount of reversal? 20 lakhs into 30%. Okay. 20 lakhs into 30%. Next, interest for financial institutions allowed, no timing difference. So we said not applicable and closed. Third one, what did we discuss? Was it a deferred tax asset or a liability that we discussed? Asset. But before we discuss whether it is a DTA or DTL, we should find out whether it is a timing difference or a permanent difference. Yoschoma? Yosikala. Okay. So remember, AS 22 la first rule whether it is a timing or permanent difference. If that is satisfied as a timing difference, then only DTA, DTL rule will come. Okay. So underline that point. I will now bold it and give it to you in your answer key. Underline that point and say that we should remember to check whether it is a timing or permanent difference. So donation, once disallowed, permanently disallowed. Therefore, it is a permanent difference not recognized for DTA or DTL. Not applicable. Okay. So For donation, remember we are not supposed to check whether DTA or DTL. We should first check whether it is permanent or timing difference. Got it? So here we are carrying 2 points from this question, friends. Point number 1. If the question is going to give you an expense or income relating to the previous year, then you should see what happened to it in the previous year. So in this case, in the previous year, it was a DTA. So whatever happened in the previous year, the amount will be reversed for the current year. Whatever has happened in the previous year, we will take the reversal for the current year. So here we call it as a reversal of DTA instead of calling it as a deferred tax liability. This is point number 1. Point number 2. When a question gives you an item of difference, first check whether it is permanent or timing difference. If it is permanent difference, ange stop. Don't even continue with the answer. Okay. If it is a timing difference, then check whether it is previous year, current year, DTA, DTL, everything will apply. Right? Please make a note of the 2 hints that we just discussed. Any doubts in the question? You can get from there. Or for now, you can share. Probably you can take it in the break. Any doubts, friends? Friends online? Second, can you close door? Okay. So this is question number 4. Similar pattern, question number 5, which has also been, which was one of your past tasks, I think June or January attempt, that earlier attempt, the attempt before this, it was asked. The following particulars are stated in the balance sheet of Deep Limited on 31st March 2020. Deferred tax liability 28 lakhs, deferred tax asset 14 lakhs. So they are having both DTA, DTL separately. They have given you. Of course, in the balance sheet, it will be shown as a net value only. You cannot. You will think, ma'am, why they are showing it as 2 different. In the balance sheet, it will be net amount only. But for calculation, they have shown 2 different items. Following transactions were reported. Depreciation as per books was 70 lakhs. Depreciation for tax purposes 42 lakhs. There was no additions to the fixed assets. Next, expenses disallowed in 1920 was allowed for tax purposes 14 lakhs. So previous year disallowed, currently allowed. Next, share issue expenses allowed under section 35D of Income Tax Act for the year 2021. 1/10 of 70 lakhs incurred in 1920. Okay. Fourth, repairs to plant and machinery was made during the year for 140 lakhs. And it was spread over 2021 and 2021-22 equally. So expense was split and recorded in the books. However, entire expenditure was allowed in the income tax for income tax purposes. So 4 items. We already have an opening DTA and DTL. You are going to calculate the impact of the above items and the net balance of DTA or DTL. So first thing, find out whether the 4 items are DTA or DTL, timing or permanent. Do the calculations. Do it on your own and we'll check the answer. Okay, so let's check the answers. First one, depreciation as per books was 70 lakhs. Depreciation for tax purposes 42 lakhs. So as per books, depreciation is more. So therefore, book profit will be less. Okay, so book profit is less, income tax profit is more. It is depreciation, so timing difference. And when income tax profit is more, we are going to pay more tax now, which means it is going to result in a deferred tax asset. Okay, deferred tax asset. So in this question, both answers are valid. If you have written deferred tax asset or deferred reversal of DTA, both are valid, because here this is current year depreciation. Current year depreciation is current year's expense or income, so we can call it as a deferred tax asset. It is not pertaining to previous year's expense or income. But the other logic that people say is the fixed asset pertains to previous year, therefore we will call it as a reversal of DTL. That is also how they say. So don't get confused if the book answer says otherwise. Your answers will still be valid in both the cases. More tax now, which means you incur a benefit from more. Yeah. So 28 lakhs into 40 percentage, 11.2 lakhs, which is for the differential value, 70 minus 42. First adjustment clear? Second adjustment. Disallowances in 2019-20 allowed for tax expenses. So previous year I had expense disallowed. So income tax profit was more in the previous year. So income tax profit was more in the previous year, more tax was paid. So it was a previous year it was a DTA. So current year it is a reversal of DTA. 14 lakhs reversal of DTA, deferred tax asset reversal. 14 lakhs into 40 percentage, 5.6 lakhs. Please hold. We will discuss the answer. We'll discuss. Third, share issue expenses allowed under 35D. Now, share issue expenses generally, this in income tax it is allowed as over a proportionate period. Okay, so they have told that it is taken as yeah, so they have told it will be allowed over a period of 5 years, generally amortized over a period of 5 years. Now, the amount incurred is 1/10 of 70 lakhs. Correct? So your answer is in the previous year, okay? In the previous year, was this share expense allowed? The question is saying share expense allowed is allowed in the current year. So previous year, what is it? Was it allowed? Why am I saying previous year? Expense was incurred in 1920, but allowance is happening only in 2021. So in the previous year, was the tax expense allowed? No, it was not allowed. So in the previous year, it was your income tax expense was not allowed. So income tax profits will be more. So we would have paid more tax, incurring a benefit for the future. So now in the current year, it will become a reversal of deferred tax asset. I repeat, in the previous income expenditure was incurred in 1920. So it pertains to previous year. Previous year that amount got disallowed, or it has not been fully allowed, in other words. So in the current year now what has happened? I am allowing this expenditure. So now let's go to the previous year story. Previous year income tax disallowed. So income tax profit is high. Book profit is less. So when income tax profit is high, we will pay more tax for a benefit in the future. So pona varsho it is a DTA, deferred tax asset. Now therefore current year it is a reversal of DTA. Is very clear? Now for the amount, 7 lakhs into 40 percentage, 2.8 lakhs. 7 lakhs into 40 percentage, 2.8 lakhs. Okay. Next, repairs to plant and machinery was made in the current year for 140 lakhs and was spread over the period 2021-22 equally in the books. Sorry? 7 lakhs only, no? We have calculated it. Okay, you are asking for what should I do with that 70 lakhs? They are saying the total issue is 70 lakhs, of which 1/10 expense was incurred, which is 7 lakhs was incurred in 1920. But that that expense was allowed fully under 35D only in the year 2021. Basically, expense incurred in the previous year allowed current year. Normally, இது வந்து proportionate allow ஆகும்னு நினைக்கிறேன் உங்களுக்கு income taxல 1/5 அந்த மாதிரி allow ஆகும், but here they are saying full amount is allowed. So let's go by the whatever is given in the question. If the question is silent, apply the provision as it is. Okay. So shall I go to the fourth one? Repairs to plant and machinery made for the year 140 lakhs spread over 2021 and 22. So in the books, what is the recognition? 70/70. Correct. Now the entire expenditure was allowed in 2021 itself. So in books it is 70/70, whereas in income tax entire 140 in the same year. So in the current year, which profit will be more? Income tax profit is less because more expenses are allowed. So income tax profit is less, therefore lesser tax. So it is a deferred tax liability. Deferred tax liability 70 lakhs into 40 percentage. Hmm. Yes. Less tax. Tomorrow there will be a liability. Right? So clear with the 4 adjustments? Now your values, I repeat, are going to be 11.2 lakhs, 5.6 lakhs, 2.8 and 28 lakhs. Okay? The impact of the difference into tax percentage. Impact of the amount into tax percentage. So 70 lakhs into tax percentage. Right? Now, if they ask you to calculate the closing balance of DTA or DTL, then adjust the opening balance, add or subtract your adjustments, and you will finally arrive at your closing balance of DTA and DTL. Right? Okay. So you can arrive at your net balance, or you can even do all DTL adjustments in one side, DTA adjustments in one side, and you can find both the answers separately. If they ask you to calculate the closing balance, but they generally will ask you only to show the adjustment impact. Okay. If it is asked, then you can do the calculation. Is that clear? Any doubts with respect to AS22? So this summarizes, we have discussed questions relating to adjustment of provisions. We discussed a scenario on tax holiday adjustment. And if MAT adjustment is asked, then you just have to remember we will have two profits that we need to consider for MAT difference. Okay. I believe there is one illustration in your study material for MAT adjustment. You can look at it for in your study material. You can look at it for, if you want to have an example look, you can have that thing looked at. Your first chapter itself is AS, right? In that there is the question available. ஒரே ஒரு question தான் இருக்கு that you can look at. Okay. So this summarizes AS22. Any doubts in the standard? Okay. So now we go ahead to the next standard. So we are left with AS 24, 26, 29 and 18. Okay, predominantly theory oriented standards. So let's start with AS 24, a smaller standard. Practically, it is a disclosure related standard. AS 24, discontinuing operation, is a disclosure related standard. Okay. Now, what is a discontinuing operation? So this standard is going to speak about what is this operation and what is the disclosure relating to this operation. That's all. So what are discontinuing operations? Operations are nothing but the activities carried on by the enterprise in the course of business. Now a discontinuing operation is those operations, number one, which the enterprise, which is the organization, pursuant to a single plan, this point is relevant, pursuant to a single plan, decides to abandon the operations or activities, sell or demerger, sell or demerge either in full or in piecemeal, which means I can either sell it away in a bulk or I can sell the assets in in installments, or disposes any part of the assets. Like disposes here means scraps or throws away, right? So there are three parts: abandonment, sale or demerger, disposal. Now all these three, the abandonment is abrupt. Immediately I decide I leave the place and I abscond. Sale or demerger will happen either in one shot or it can happen in a phased out manner. Disposal also can happen in one shot or it can happen in a phased out manner. But whether it happens in one shot or phased out manner is not important. What is important is whether it is pursuant to a single plan, which is it should be based out of a single plan. Your decision to do the disposal or sale or demerger should be in a single decision or through a single agreement. Okay, a question has been tested on this, saying that a company wanted to sell its assets, it sold its assets over 6 months period. Does it amount to demerger or does it amount to discontinuing operation? If it is under a single plan, yes. If it is not under a single plan, no. The decision making. I decide to close this particular unit and gradually I will sell away these assets. That is what the decision made to close that unit is the single plan. Okay, the board's decision to close the unit. Or sometimes I may not decide to close the unit, but I will want to do some cost cutting, so I will keep selling away some assets. No, that is not a single plan. Okay, that is the difference between the two. So this is point number one for discontinuing operation. Point number two, the operation has to be distinguishable business or geographical segment. If you are following AS 17, whatever is reported under AS 17 will apply. Else, you have to distinguish, you have to have a separate distinguishable segment. Third, risk and rewards pertaining to that operation should be independent and cash flows to the operation should be independent. So if these three conditions, if all the three conditions are satisfied, then it will be classified as a discontinuing operation. So first, it should be pursuant to a single plan. Second, it should be distinguishable segment. Third, it should have significantly different risk and rewards and independent cash flows. So three conditions for identifying as discontinuing operation. Friends, the standard will use a little more elaborate terms, but I have simplified it so that this keyword is easier for you to remember for the exams. So you can use this keywords for writing in the exam and you will easily be able to present it clearly in the examination if asked, right? Now, what are the activities that are not considered as discontinuing operations? So what is not discontinuing? A gradual phasing out of product line. Say for example, I am introducing a new model. So my old model goods or old model item I am going to phase out. New model car is introduced. Therefore, old model I am gradually reducing the production and stopping it. Okay. So that is a gradual stop of a product line, which is not an identifiable separate segment and which is not a operation which is discontinued through a single plan. So therefore it is not a discontinuing operation as given in the standard itself. The standard has given the examples. Okay, so you can quote the standard as per AS 24. The following operations cannot be shall not be deemed as discontinuing operations. Second, discontinuing several products within an ongoing business, which means in the same segment. Say suppose you are in the consumer segment or you are in the retail segment, and in that retail segment you are having multiple products. Clothes, you have multiple types of clothes. You are now doing away with some models, some designs, and you are only going to focus on certain other designs. Then within the same segment, if I am discontinuing some products, then that also does not amount to discontinuing operations. Okay, so here within an ongoing business is primarily within same segment, right? Third, shifting of location of production or marketing activities. So for practical reasons or for economical reasons, okay, if your company is shutting down one plant and changing its location of activities to another plant where the business is not discontinued, only the location is changed, then it is not discontinuing. Fourth, closing a facility for cost improvement. If I'm shutting down a facility to because it is loss making, so I want to improve the cost, I want to cut the cost. So in that case, if I'm shutting down some facility, remember here we are using the word facility and location, we are not using the word segment. Okay, if I'm shutting down a facility or location, then it does not become a discontinuing operation. So four situations where it will not be deemed as discontinuing operations under AS 24. Clear? So first we have seen what is a discontinuing operation. Second, we have seen what is not a discontinuing operation. Third, when the same should be disclosed in the books. When we should disclose a discontinuing operation in the books. When the intention of such discontinuance is made public, which means when an announcement is made, okay, or when a news is declared, officially declared. So when the intention of such discontinuance is made public, and or a binding agreement for sale or merger is entered into. Say if it is a company, they have to pass a resolution and form an agreement. If they have to sell or demerge, they have to form the agreement. So when the agreement is complete, then it shall be deemed that the operations will be discontinued. So two conditions for the timing of recognition: one, intention should be made public, and if there is an agreement requirement, the agreement should be created, or the agreement has to be entered into. So when the operation becomes discontinuing, you have to disclose what are all the items relating to that operation. Like for example, from which date it was discontinued, what is the current income and expenses for that, if there is any fixed income or expenses, what are the cash flows relating to that operation, are there any separate assets for that operations, segment assets. So all these information has to be separately disclosed in the financial statements, right? Similarly, if an operation becomes from discontinuing, it becomes a continuing operation, again you are restarting, then from that date it will stop being classified under AS 24. You will go ahead and continue to record it as continuing operations. Simple standard, just three rules to remember: what is a discontinuing operation, what is not a discontinuing operation, when recognition to start. In the mood point, you can remember for your examination. Yes? Straight away to question number 6. What are the disclosure and presentation requirements of AS 24 for discontinuing operations? So in the answer key, I have given some points. Let's just quickly run through the points. Okay, you can make a note of them in your notes, or the PDF will anyways be available to you. The enterprise should include the following information relating to the discontinuing operations in the beginning, with the financial statements for the period which initial disclosure events occur. First, description. What is the type of operation? Second, the segment in which it is reported under AS 17, if AS 17 is applicable. Third, date and nature of initial disclosure event, when and how it has happened. Fourth, the period for which the discontinuance is expected. Is it an indefinite discontinuance, or is it for 5 years, 6 years, 7 years? We need to disclose. Carrying amount as on the balance sheet date. Total assets, total liabilities. Amount of revenue and expenses with respect of the activities. Amount of pre-tax profit and amount of net cash flow. So first 4 points is about nature. What is the segment? What is the segment under AS 17? What is the nature of discontinuance? Till when the discontinuance will happen? அடுத்தது all financial statement item. Balance sheet, assets, liabilities. Then income, expenses, profit, loss, and last will be cash flows. Okay, so these are the points that we have to disclose under AS 24 for discontinuing operations. Question number 2. Give 4 examples that do not necessarily satisfy the criteria of para 3 of AS 24. What is para 3 of AS 24? It is nothing but that which is not a discontinuing operation. So what are the 4 items? Gradual phasing out of a product, discontinuance of several products of a business. Third, shifting of location. 4, closing a facility or location to improve cost benefits. It can be both. It can be both. It can be both. Okay. So these are all the scenario where it will not be deemed as discontinuing operation. Question number 7. One of your past asked questions. Rohini Limited is in the business of manufacturing of passenger cars and commercial vehicles. The company is working on a strategic plan to close the passenger car and produce only commercial vehicles over 5 years. So they want to close down cars business and only go to commercial business. Now, no specific plans have been drawn up for the sale of neither the division nor its assets. As a part of its prospective plan, it will reduce the production of cars by 20% annually. So it will keep reducing the production. It also plans to establish another new factory for manufacturing the vehicle and transfer the surplus employees in a phased manner. You are required to comment on the following scenarios. What are the following questions? If a mere gradual phasing out itself is considered as a discontinuing operation. No, a gradual phasing out shall not be deemed as a discontinuing operation unless a situation demands otherwise. Okay. Second, if a company passes the resolution to sell some of its assets and also transfer the assets to the car division, does it trigger application of AS 24? It is only selling some of its assets. Is it a single plan? No. So you will say, because the resolution to sell is not derived out of a single plan, it does not qualify under AS 24. Third, would your answer be different if the company resolves to sell all of the assets of the company of the passenger car division in a phased but time bound manner? So when they say phased and time bound manner, there is a plan. Correct? So when you have a plan, you have a time limit, you have a target. So when it is a phased in a time bound manner, there is a plan to sell the assets. Therefore, it can be classified under discontinuing operation. Okay. So a passenger car division will come under AS 24, discontinuing operation. The other division will still go ahead in the normal scenario. AS 4, 5, adala will apply. Amma, இத மட்டும் discontinue, you will disclose. That's it. So answer to question number 1, it is not discontinuing. Question number 2 also, it is not to be treated as discontinuing operation. And third, it will be treated under discontinuing operation. Okay. So the first part is the theory portion or the definition portion of the standard. So I'm just reading out the portion relating to the conclusion. In first scenario, in this case, it cannot be considered as discontinuing operation as the company's strategic plan has no final approval through a resolution and there is no time bound activities. Okay. Second case, no resolution is silent about the stoppage of the car in a definite time period. So there is no time bound period. Though some assets and some of the transfer proposals are passed through a resolution to a new factory. There is no roadmap for closure and starting of a new factory. Whereas in the third case, yes, it is a phased and time bound program that is resolved for indicating the closure of passenger segment and conversion of commercial vehicle segment. So it will be covered under discontinuing operations, right? So this summarizes AS 24 discontinuing operations. Simple 3 points for us to remember, but remember to write the keywords when we are writing this standard. Okay, the hint given in the material is only the keywords. I have not reproduced the standard asset, so remember those keywords, and if you are reproducing them, at least it will be easier for you to write in the exam, right? Take a quick break, 10 minutes. We will resume for the next standard. 11:1 here, so 11:10 we resume for the next standard.